Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 260th VideoCast podcast for the week ending October 9th, 2024, live from New York. Very excited to be here. For family first, then we'll get down to business. This is Mimi, and she is with a couple Olympians here. Did a clinic with the Pepperdine water polo coaches, and they went to Sky Zone over the weekend. Okay, well, that's more information than you needed. But she got to hang with the Olympic medals, which is awesome. Then that's Mimi and Annabelle getting super. That's the Sky Zone. This is Mimi rowing in Newport Beach. This is Pepper and Lucky. I can't leave them out. I brought them home some steak from this Peter Luger-like place in Long Island after we played Bethpage Black. So they got the bones. They were super jacked up. That's her water polo team of 908. That's their 12 and under water polo team who moved up to the top division in the Southern Pacific Water Polo League for Annabelle's 12 and under. 908, that's pretty exciting. And this is me and my buddy Rob playing Bethpage Black this weekend. That is the 18th hole, which I did par, by the way. I smoked the driver, pitching wedge, 2-putt. Other 17 holes, not so much. That's also our friend Warren, who's an unbelievable stick. He's only been playing for 6 years, and he is a scratch, basically. That was that shot on 18 that they caught. This was one of the par threes. They're playing the Ryder Cup next year, so I got a Ryder Cup hat. Pretty exciting. That's Fox Business Green Room for Varney today. That's with Mike Lee, my buddy. He actually grew up in the town that we live in Connecticut, and that's Preston Mizell, one of the producers for Varney & Co. today. Two of the best guys out there. It was a blast catching up with them in the green room, and also with Mark Tepper, who I didn't have a chance to get a picture with. Speaking of media, want to thank Preston Mizell and, of course, Christian Dagger and Stuart Varney for having me on the show today. We're going to listen in here.
Let's get back to the markets. The biggest gainers on the Dow, accounting for some of this 164-point gain, are Goldman, United Health, and Caterpillar. They're all up sharply. Dow's up 158 points. Tom Hayes joins me now. You watch the market for us. Okay, we've got the CPI tomorrow, Consumer Price Index. It's expected to go up 2.3% year over year, 2.3% inflation. If it does that, does the market rally?
I think it's good for the market. The thing that I've learned over the years, Stu, is the secret to happiness in life is low expectations. So we've got a low inflation number at 2.3%, which is consistent with what is expected of the Fed in November, an 87% chance of a 25 basis point cut, a 78% chance of a 25 basis cut in December. So long as that number's in the neighborhood of 2.3%, they're going to follow through with those cuts. That adds liquidity to the market. And I think maybe a few bumps in October, but I think going into year end, we're going to be just fine, and the Fed's going to follow through with those cuts.
So the market rallies?
The market will go up on balance before the end of the year. Does it rally the next minute? Perhaps. The key is liquidity is coming from everywhere around the world. We've had the most amount of central bank cuts happen since 2020 and 2009. Those were times to be buyers of equities, not sellers.
You make a big distinction between the Magnificent Seven, which have almost stalled, not quite stalled, but they're not making the big gains that they were, versus the other 493 stocks in the S&P 500. That's where you want to put the money, right?
That's right. You don't want to swim against the tide here. We started the year, the Magnificent Seven had 50% earnings growth. They're down to the mid-teens earnings growth, whereas the unmagnificent 493, they had negative earnings growth until the most recent quarter. They've just started to inflect positive, and as that trend continues, they're going to be at mid-teens earnings growth over the next couple of quarters. That's where all the money is going to be made, Stu. There are still stocks down 50%, 60%, 70% that are great companies that are going to be doubles over the next 2-3 years.
All right, Tom Hayes, we understand. Thanks so much for joining us.
Thanks for having me.
Come and see us again soon. Ashley.
And we're back. And then wanted to thank Marianne Starr Inike for having me on CNA News Asia, which is like the BBC of Singapore, last night. Listening here.
Now let's bring in Thomas Hayes, Chairman and Managing Member from Great Hill Capital. Good evening to you, Thomas. So basically, at the moment, we are looking at more volatilities in the market since the start of October. So looking ahead, what kind of downside risks that investors should be watching out for?
Well, thanks for having me, Henry. I think that it's simply that time of year. If you look at the presidential cycle, the fourth year during an election year tends to be a more choppy season. We're trading at 21 times forward earnings. The market is pretty fully valued, and we're starting earnings season this Friday with the big banks. JP Morgan, Citibank are going to report earnings. Earnings are expected to be a little bit lower because of light loan demand and decreasing net interest margins. So I think you could see some choppiness and some uncertainty into the election. We have raised some profits, raised a little bit of cash to be able to buy in if we get any weakness before the election. And I think once the election clears, Henry, after early November, I think you're going to see a year-end rally. There's a lot of pent-up demand, a lot of managers behind their index that will have to chase into year-end.
Mm-hmm. And we're also closely watching U.S. inflation number coming out later this week. In the situation that Fed is less aggressive in its rate cut plan, so how do you think investors should prepare for that kind of situation?
Well, headline inflation is projected to come in lower than last month, 2.5 last month. Expectations are for just 2.3 this month, which is very subdued inflation, which would actually put a clear indication that we could see 25 more basis points of cuts in November and 25 more basis cuts in December. So a total of 50 more basis points cuts, provided that number comes in as weak as anticipated headline inflation on Thursday. So we've got the inflation numbers on Thursday that are going to be critical as it determines what the Fed is going to do in November and December. And we have earnings. The key thing about earnings is expectations for Q3 earnings growth as of June 30th were 7.8%. Analysts have brought down expectations to just 4.2%. So they've lowered the bar. And a saying I always like to say, Henry, is the secret to happiness is low expectations. And they've set the bar low for Q3. So we may see some positive earnings surprises as the weeks wear on, which should bode well for the end of year performance after the election clears.
Mm-hmm. And we are seeing some rotation happening, especially in tech sector as well as small cap stocks. What's your take on those?
Yes. Yeah, I think what you see historically after the first Fed cut, and today was a one-off, certainly tech did well. They've been beat down the last couple of months, so they're gonna see a bounce. But I think if you look past a few days or a few weeks, after the first cut and the easing cycle begins, what we're seeing is a broadening of participation in the market. So the tech-centered Magnificent Seven have been underperforming in recent weeks, and the unmagnificent 493, I like to call them, the rest of the S&P 500, have been outperforming. You'll see it in fits and starts, but on balance for the next 12 to 18 months, we believe that theme is going to persist, which does mean small caps will start to outperform large caps. That's historically true in the first 12 months following a Fed cut. By 11%, small caps outperform. Value stocks outperform growth stocks in the first 6 months after the first Fed cut. And emerging markets will start to outperform developed markets for the first time in basically a decade. And that's due to, number one, a continued trend of a weakening dollar. And the Chinese government, although they didn't give the market what they wanted today, after a 50% rally, we gave in a handful of weeks, we gave a little bit back today and probably will for the next couple of weeks, consolidate those gains. They'll be back in the market. Their initial indication was they were going to do what it takes. And I don't believe they want to give up the gains that they've already seen and get their country back to that 5% target that they set.
All right, Thomas, thank you for your analysis. Thomas Hayes, Chairman and Managing Member with Great Hill Capital.
And we're back. And then quotes of the week. And there's so many quotes of the week because they were all perfect. So our new guy, Jeff, is just doing a good job of picking these, or he's just getting lucky with the timing, but I think he's doing a great job. This is Ray Dalio. The biggest mistake investors make is to believe that what happened in the recent past is likely to persist. I've talked about that a lot on the podcast. It's called recency bias, and we're going to actually spend some time on it today as it relates to China. Seth Klarman, the single greatest edge an investor can have is long-term orientation. I call it time arbitrage. When your framework is right, you get paid for sitting on your hands. Entrepreneurs get rich through massive action. Great investors get rich through massive inaction. And very few people can do it. Oh, by the way, key announcement for existing and new clients. I sent you an email tonight with 2 very important points. I can tell you right now, you are going to be smiling so wide, you could eat a banana sideways. And the first point you're going to love. And the second point, you are the first ones to have access to this, and we'll keep it that way for some time before we roll it out. So do check your email. If you didn't get an email entitled important, reach out to me, but it's going to be a good read for you. Here's Buffett. You do things when the opportunities come along. I've had periods in my life when I've had a bundle of ideas come along, and I've had long dry spells. If I get an idea next week, I'll do something. If not, I won't do a damn thing. And that's very interesting because we've had a lot of money coming in the last week. And I've actually purposefully, and for those of you who are existing clients, you know we've taken profits on a lot of options that we've made a lot of money on. And but we've kept all the stock. And so the first thing that I said to all the new money that came in is, don't be surprised if we're sitting on cash for a few weeks into the election. We want to be in a position to take advantage of any dislocation or seasonal or pre-election jitters if they come along. If they don't come along, there's always stuff to do. And we've been able to put money to work. But if you are thinking about coming in or adding money, a lot of people have been adding money to their accounts. Now's the time to do it, even if it sits and collects interest at Interactive Brokers for 2 or 3 weeks until I can pounce. It's one name we're already going to start pouncing on, but go ahead and do that. And you don't want to try to get money in when it's middle of the opportunity cycle. You want the money sitting there ready to go and ready to pounce. And that's what Buffett's talking about. So, that's how you balance it. So great quote there. And then Robert Arnott, successful contrarian investment requires us to live with discomfort for being wrong and alone. But bargains do not exist in the absence of fear. We've seen that with Alibaba. We've been through the hellscape, and now we're getting into the sunshine. And here is a key lesson. What most people do is they forget why they got into the business. And the minute they start making a lot of profits, they are so quick to want to sell the profits and book a win or get back to even and get out. That is a cognitive bias that is so disconnected from what is the value of the underlying business today based on its earnings power, cash flow, and what do we expect relative to tomorrow. And the fact of the matter is it's been derated due to despondency and pessimism, which is going to eventually turn into euphoria and greed, and we're nowhere near that point yet. So don't make the fatal mistake that people do when a position takes longer than expected and they get stuck in what happened in the recent past will persist, i.e. things have been terrible in China, therefore things are going to stay terrible in China. It's usually just the opposite. All intelligent investing is value investing, acquiring more than you are paying for. You must value the business in order to value the stock. Charlie Munger. By the way, Charlie Munger had a huge position in Alibaba and inside of the Daily Journal. or was it Westco? It was the newspaper company that he had. Anyway, I forget what the name of it was. It's late. It's been a long day. But I got to get this done because I'm headed out to Arizona to see the water polo tournament this weekend. Super excited to watch Rocktober in Scottsdale. Not bringing my golf clubs. Going to spend all the time with them and back on Monday. So you must value the business in order to value the stock. And this is what we try to teach every single week here. And finally, Benjamin Graham, most of the time common stocks are subject to irrational excessive price fluctuations in both directions as the consequence of the ingrained tendency of most people to speculate or gamble to give way to hope, fear, and greed. And we try to take advantage of that and benefit from that. Let's go into our data for the week. This is a critical, important lesson, ladies and gentlemen. There is an author or a writer at Barron's that we've talked about in the past, and this person is chronically pessimistic without fail about China. And I want you to see how opinion follows trend as evidenced by this writer's headlines over the last about a year and a half, 2 years. So here is 2 days ago when the market gave back a few points after 50% rally in a few weeks. China's stock surge could fizzle soon. Here's what to look for. Then here's what happened when the market was up 50% in a few weeks. Same author. Beijing has started a new bull market. Here's what stocks to own. So when it goes up 50% in 4 weeks, the headline is Beijing has started a new bull market. Here's what stocks to own. Just a few days later, when the market corrects a little bit, China's stock surge could fizzle soon. Here's what to look for. Same person, same view, different view. Largest weekly inflow ever to China equity funds, which is why we told you last week they will punish this late money. I'm always looking at BABA. You could look at KWeb, whatever. That came in around 120. They'll smoke them out. They'll puke it in the hole, whether that's 105. I think 98, 95 gets them out of their stock that they bought at 115. And then we rip higher. If we get to the high 90s, I'm going to put the options back on that we took off 5, 6, 7x, depending on when the account was started and the opportunities that were available at the time. That was just huge for us, and that's why we're sitting on so much cash from the option profits, and we're going to just be patient to deploy it outside of that one name we're going to pounce on. Stock turnover surges on Hong Kong amid rally, so that's that. Now, I just want to go through these headlines to make a point how these type of headlines take you out of quality companies when you don't know what you own. And when you do know what you own, you still have to have ice in your veins and internal fortitude to sit through because it's relentless. Here, FOMO on China stock rally, think twice about buying. That's up after it was up 30, 40%. China's stimulus may keep from spoiling the global economy, but it still isn't enough. China's economy is sputtering. More pain may be ahead in 2025. China's troubles are hitting home for U.S. companies. And by the way, I'm not cherry picking. This is every article this person has written about China. China giving mixed signals on its economy. That's a problem. Another Politburo meeting ends with no pivot. That's grim news for China's economy. China responds to economic concerns with rate cuts. Why that isn't enough. China's economy is in a rut. Its demand for commodities remains strong. How does that make sense? China's economy isn't gaining much steam. Why that could be a problem. China is fighting economic malaise. Why stimulus isn't enough. China's slumping stocks need help from Beijing. Don't count on it. China recovery may pick up. Here's why it may be a selling opportunity. Alibaba's woes illustrate broader China concerns. China's slump is still hurting consumer stocks. I mean, this lady is unbelievable. China's economy is doing a little better. Why it won't lift stocks. China's economy is stabilizing. September's data may disappoint. China tries to revive the stock market. Why gains may not last. Now, if you figure out, anyway, I'm going to leave it at that. Just as China's economy slows, commodities are holding up. China's economic meltdown could spread. Here's how. China economic pain is deepening. Don't expect a quick rescue. U.S.-China relations take another hit. Now what? China's recovery has a big weak spot. China stocks are a bust, where the bulls are setting their sights. China stocks have lost their mojo. New laws are spying. By the way, this person is going to be forced to write the most glowing headlines when Alibaba's at 200. It's going to say, China's rally is just getting started. Why investors can't get enough. Why China is going to take over the U.S. as biggest GDP. That's when we're going to be selling. The minute they say that China's GDP is going to take over the U.S., that will be when we sell our first tranche of stock. China shares feel the weight of a U.S. crackdown. China consumer-led growth looks more like a bounce, not a recovery. Xi talk on China's private sector doesn't reassure investors. China's latest economic plan doesn't offer much to bulls. All of this was in the hole, taking you out of your stock at the exact wrong times. So you've missed the whole run up. I'm not saying you, because people listening to this have probably been more steadfast. But China stocks are, and this is why, if you don't know what you own and you haven't done your own work, it doesn't matter who you follow or what you follow, you're going to get shaken out from nonsense like this. China stocks are rebounding, but maybe not for long. China bulls beware, winding down the zero COVID policy. I mean, this is like a hired hitman for anti-China headlines. And I'll give you a hint, though. It would be like hiring an Iranian to write headlines about Israel. I mean, you just can't make this stuff up. I mean, the bias is so pronounced, and sadly, it's taken so many people out of stock, out of Baba at 60 and 70, and now they were forced to buy it at 115, 120, and they're getting their teeth knocked out. And at 95, they're going to sell in the hole again because she's going to write more bad headlines, or someone like her. And then it's going to rally back well past 140, and the next stop will be 160. And at that point, she'll say, don't believe it. And they'll all buy up, and then it'll pull back to 140. And we've gone through this. They'll sell in the hole, and then it's 200. Everyone's going to want it. Pull back to 180. It's just going to be over and over and over. Xi's third term spells trouble for investors. China's Party Congress offers little for the economy. Look, I took the time to copy and paste these for a reason. This is a monster education. If you buy quality companies when they're marked down and have confidence in your work and your framework, you can withstand this, because this is what you have to go through to get these stocks at a bargain at a dislocated period, because they don't give away multi-baggers for free. That's just the way the world works, ladies and gentlemen. So here's the expected S&P 500 earnings growth, Mag 7 versus Unmagnificent 7. And as you can see, Unmagnificent 493, as I talked about, this is from FactSet. So the 493 has just turned the corner from negative to positive. Then they start to catch the Magnificent 7. Remember, the Magnificent 7 was at 50% earnings growth just 2 quarters ago. Now it's going down to 17 and 16 and 15 and 14, whereas the 493 were at negative. Now they're 1.7, 13.9, 14.2 by Q1, 13.0 Q2 of next year, 15.6 of Q3. So that's the story there. We saw the jobs report was good. Here's the Hang Seng, got up to this resistance, pulled back. Everyone's panicking, saying it's a fake out. They're not going to do the stimulus. They have to do the stimulus. They pivoted not because they wanted to, because they were forced to, and that will follow through. And even if you remember, if you don't listen to what I'm telling you, listen to what David Tepper said last week. He said, we've already gone over our position limits. If we're lucky enough to get a pullback and shake some people out, we're going to again break our upside position limits and buy more. And these are the type of headlines. By the way, not only am I sending a Christmas card to Xi for waiting so long and forcing me to buy so much stock at low prices to bring my basis down so low, I'm also going to send a Christmas card to this author, to this journalist, for taking so many people out of their stock so we could buy it low and now have the benefits of riding it higher. And we're just in the early days. For those of you who think the last few weeks has been the greatest thing since sliced bread with all the money we made on the options and even the stock, which has been phenomenal, you ain't seen nothing yet. So if you think the email I sent you tonight has you smiling so wide you could eat a banana sideways, wait till you see what's to come. Okay, so moving on. Dock workers strike. Okay, so that's funny. That guy was, it's hysterical. he said, he was cursing on TV saying, we're going to hold up the whole world, blah, 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 until they give us what we want. One article in the New York Post showing an overhead picture of his 7,000 square foot mansion and his Bentley parked in the driveway. And it was settled in 24 hours. You can't make this stuff up. All right. So this shows China stimulus in 2018, 2016, 2020, followed by a rise in valuation. So we're well below the mean PE average. And again, we're derated by 50%, and that excludes the earnings growth that we're going to see in the next 24 months. So you can do the math on that, which means double on current earnings power as it re-rates, and then as earning power expands, you add to that. China property, Shanghai and Shenzhen luxury home sales soar after stimulus package. Largest weekly inflow ever into emerging market equity funds, including China. Of course, they got to get their teeth kicked in after chasing the top. And then once they're fully despondent because they sold at the bottom, bought at the top, flush them out again, they'll never come back except when we hit 200 on Alibaba. And that'll be that. Emerging market equities at lowest versus U.S. since 1969. I think a better framework is 1999. Everything's setting up very similarly to that. And 2022 to 2001 to 2007. We covered it a million times. Small caps, emerging markets, and it's playing out. Okay. Average annualized returns during U.S. political regimes. It shows when you have full Republican control is the best for small caps. When you have a split, let's see here, the second best is full Democratic control. So small caps like full control from either party. The rest of the market prefers a split. Okay, Japan rules out Bank of Japan interest rate hikes for now. Okay, that means until after the election, they're going to have to do it because of their inflation. Here's KWeb, which had the largest fund flow. Brendan runs that. By the way, I shared with you. Super great guy, super great golfer, by the way. Great course that he invited me to. So biggest weekly inflow. So, you get these type of spikes, and then it's got, you got this at the beginning of the last rally in 2019, and then it kind of cools down and the market goes up. Utility sector, this is overdone. It's already started rolling over. We warned you about that. Hope you took advantage. China equity has delivered one of the strongest and most concentrated rallies in its history so far, which implies more upside moving out if you look at historical models. 10 reasons to buy China equity. This was 2 days ago. Government has revealed its pain threshold, so they finally blinked. This time is different. Investors are getting what they hope to for a large extent. Don't fight the PBOC. Policy U-turn provokes re-rating trades that have seldom stopped there. Powerful and tradable rallies can exist even in a prolonged deflationary bear market. Inexpensive call options. FOMO has room to run. Profit outlook is improving. Fed has loosened one constraint on China's stimulus, and China equity still has a place in investor portfolios. Ironically, this is from the same sell-side shop that had a uninvestable rating on it before it rallied 50%. Equities tend to rise when interest rates fall, so long as there's no recession. We've covered that. Same thing. This is the liquidity that I was referring to on Varney & Co. We've got the most Fed cuts, 26 in the month of September globally that we've had since 2020 and 2009. Those were times to be buyers of equities, not sellers of equities, so we'll pick our spots smart. Thing to keep an eye on is earnings estimates have come down from 227 to 277, 278 down to 276. I also referenced with Stu, the secret to happiness is low expectations. So estimates for earnings have gone from 7.8% for Q3 on June 30th to 4.2% for Q3 right now. So they've lowered the bar, which will make it easy to step over, which should be a positive surprise getting through earnings season. Although banks start Friday, they're expected to be weak because of low net interest margin and slower loan demand. That is going to be followed up soon by the IPO machine kicking off, and probably looks like, I mean, maybe they'll get bank some out here in Q4 and try to get bonuses. I mean, given how bankers think, that wouldn't surprise me at all to just like the election clears and they just start banging out IPOs, which would imply they'll probably have a decent fourth quarter. We took profits on all the big banks over the summer. We still own a regional basket, which we will hang on to, and maybe re-add the banks if they fall back, but not holding our breath. That was a good trade. Here was net call volume in the FXI. Obviously, you got to smoke all these people with the premium. Once you burn through that premium, you can start to rise again, which is also what we said about October, if you remember, that there was so much, we talked about the put skew, that there was so much premium purchased on a catastrophic fall that probably the most pain to the most amount of people, which is what the stock market is designed to do, would be grinding sideways through the month of October, which is basically what's happened on a day-to-day basis, and all of that put premiums getting burned through, which makes a lot of sense. So let's see, what else do we have here? So, this is a great chart, this Shanghai Shenzhen CSI 300 index. You can see after these parabolic moves like you saw in 2020, it grinded sideways before it made another huge move straight up. So this would be normal. And we covered the two scenarios. We're going to cover a couple scenarios in the article of the week. But one of our things that we said that had to happen, we needed the Fed to cut. That happened all of a sudden. China stimulates, it's off to the roof. We needed China bond yields to go up. Look what's happened in the last few weeks. China bond yields have gone up. And look what else happened that I said had to happen is the yuan needed to appreciate relative to the US dollar. And look what started to happen in the recent weeks. So all the pieces that we've laid out for you are all coming together at once. New natural gas power plants announced in 2024 continue to grow as these data centers grow. It's going to be good for Comstock, which we love and we own. Option skew we covered ourselves. Value versus growth in different interest rate environments. Value outperforms growth in a 4+% interest rate environment. I think that is going to be potentially, I think the terminal rate is going to be higher than most people think, and we've talked about that. And that's predicated on my view that this is more like 1995, a mid-cycle easing, which would imply 125 basis points, and then off to the races for another 4 to 5 years. And in that case, we're in 4 to 5, value outperforms. You got a 2002 to 2007 environment, emerging markets, small caps, yeehaw, smiling so wide we could eat banana sideways. Let's go over to Slumer, thanks to my buddy Rick, over at RB. Anyway, let's take a look at Slumer, not Rick, Robert Slumer over at RBC. And just to give us some broad stuff, you can see the S&P here has been consolidating for a while. It broke out. It's breaking back to retest. Maybe we get a full retest here in the month of October, and then we work our way higher. We will see. Here's the daily chart. Could push higher, could retest, or could grind sideways for a little bit, which I think is the base case here. But, this is a cup and handle for those of you technicians. We don't spend a lot of time on this stuff, but it's worth paying attention to what other people pay attention to so you can know what to expect. Equal weight breaking out silently. No one's paying attention to it. This is equivalent of the Magnificent 493 type of scenario. NASDAQ corrected. It's not yet at that breakout level, but trying to work its way back. Mid caps broke out quietly. They're getting ready to take their next leg higher. Same with small caps. Everyone's saying small caps are crap, except for the fact they've been going up all year, and they're ready to break out to all new time highs. And he's got a 161 target, I guess, Elliott wave. If you do the cup and handles, it's usually measured move. So it would be 400 points above that. It would be 1900 on the 600, which means a lot of stocks are going to triple and quadruple. And same thing with the Ruddy. Everyone's saying small caps are crap, except for the fact they've been going up all year, and they're going to break out. So other than that, how was the play, Mrs. Lincoln? September weekly seasonality since 1946 shows some weekly weakness in the third week of October, which is why we're not redeploying all the profits and we're just sitting with it on our hands. And if we're wrong, we'll still find stuff to do. And if we're right, we're going to have an absolute shopping spree, what they used to call back in the day, for those of you who knew what Kmart was before a big hedge fund guy destroyed the business. It's called a blue light special, ladies and gentlemen, and the blue light we think will be flashing shortly. MSCI Europe, same story, starting to move. And remember I said emerging markets will outperform developed markets, small will outperform large, value will outperform growth, and 493 will outperform 7. That's playing out. Emerging markets just getting off the mat. This game is just getting started, ladies and gentlemen, like back in 2002 to 2007. Hang Seng, everyone said the world is ending. Things straight up. Of course, it's going to check back and test this and consolidate for a little while before the next big move. Same with the weekly. It hit this 50% retracement target from the crash. So now maybe it goes back down to this 38.2. This is all kind of useless noise, but I just give it to you guys so you have a roadmap, so you don't freak out and sell your stuff in the hole, and know that it's a normal part of the basing and rally and returning confidence process. Topics is still on the mat. I expect that to continue. 10-year yield, remember we called for the counter trend rally. Well, here we're getting it. We may be up against resistance and we can resume the downtrend with the 10-year yield, maybe a little higher before we roll back over. Dollar counter trend move. People are now saying that dollar weakness is over. I think this is a counter trend bounce. Maybe it goes a little higher before it resumes the downtrend and breaks down below. So it hit this special level. Canadian dollar, people are losing confidence. It's going up. It's going to continue to go up, as are most emerging market currencies, in my view. Euro, same story. Got up to this breakout point, checking back. Will consolidate before it breaks out higher, and so on and so forth. Crude traded with China more so than it traded. All the commentators saying it was trading with the war. It's not trading with the war. It's trading with China. Demand, you can just overlay the Hang Seng or whatever proxy you want to put on it, and that's what you get is China demand. Gold is, looks like it's consolidating. Not for me. Copper, this is a China proxy. Straight up, now it's consolidating, to be expected. You can see it again here at these magical levels that everyone's so excited about. And let's see if there's anything else we need to cover from this. Here's Baba on this. I guess this is what, Elliott wave or something like that. Elliott, what are these? Fibonacci retracements. So look, it got up to this resistance point at 23.6, and now he thinks it's going back down to 105 or 90. If it goes back to 90, it would be a gift from God. We could reload the options like nobody's business out to 2027 and make another mint. And utilities rolling over. Crown Castle will be hurt by that in the short term. I'm not worried about it in the long term. This is a counter trend move in yields. Pfizer has an activist in it. I like it. I'm keeping an eye on it. Let's just put it that way. I'm not, I can't see the path straight away, but I do like an activist, but they own, $1 billion of a $160 billion company. It's not totally relevant, but it's something. And I think there's going to be opportunity there. ILMN, this is another activist. Carl Icahn's been bagged in for a year and a half. I think this thing starts to work also. Albemarle, we own a little bit. We've talked about that one. We'll let you know if we're going to lean into it or not. But it's moving. And that's that. Next, here's update from today with Robert Slumer at RBC. Counter trend move, getting a little overbought there. Backed off a little bit at the end of the day on the 10-year yield. We'll see on the S&P. It's feeling like it wants to be breakout, but that's a fake. Could be a fake out. Let's see the inflation number on Thursday. Tomorrow, that's going to be key. And Hong Kong, here's the check back. Totally to be expected. Copper doing the exact same thing, but the new uptrend is in place. Higher lows, higher highs. On to the next, some news. China rally still has more legs. Goldman said that was 3 days ago before it checked back. Now I'm sure they have a new paper out saying we're not so sure, just like all of the weather vanes blowing in the wind. Whatever it takes is on the table. This is from my buddy over at Crane Shares, Brendan Ahern, and you should read this article. The government's going to stand behind it. And like Tepper said, they were explicit. We'll do whatever it takes. Here's my favorite website at Bloomberg that always logs me out and then makes me give a pint of blood to prove I am who I am before they let me in and give me the nuclear codes to their articles. See if they'll let me in now. I mean, it's unreal, the amount of security. PayPal completes its first business transaction using stablecoin. I don't really know what that is, but I'm glad they're doing it because it seems to be the way of the future. And we own a big stake in it, so that's a good thing. Boeing withdraws contract offer as union talks break down. Everyone says, oh, this is terrible. Let me tell you what's terrible. If you're one of these machinists and you got a mortgage coming in every single month, and you've got a heating bill coming in every single month, and you got to put food on the table every single month, and you got to pay your car payment every single month, and you're getting no income. And that's basically management's bet. We'll give you a fair deal, but if you don't want it, we're going to take it off the table. We're going to go raise $10 billion of capital. Why? Well, because the market's already priced it in. So the stock's actually going to probably rally when they actually put on the shelf offer, because each $5 billion is worth about $12 to the stock. So they'll probably raise $10 billion of equity. That'll be 24. Stock's already down 24. My guess is it's priced in. And with that credit watch thing, so they'll raise $10 billion. They'll sit on their hands for 3 months, and the union bosses will start to get screamed at by the wives of the workers that are on strike that can't put milk on the table. And that's the bet that they're playing. They've got a fair offer on the deal. Maybe they'll give a little bit more, but at some point they got to come to an agreement, because the union workers can't go raise $10 billion to sit it out for another 6 months, but the company is likely going to in a matter of days, and they'll just sit there until they bleed them out. And that's not like a wish or a hope or anything like that. It's just the reality of how it's going to work. China's property stimulus raises optimism, but more steps are needed for sectoral turnaround. Generac CEO says the pressure on the power grid is only going to get worse from weather and technology. We took off a lot of options in the last 24 hours. This was buy the rumor, sell the news. I think, but we didn't sell a share of stock because we want to own it long term. We think it's still undervalued, but we made so much on the options, we had to take profits, sit on the cash, and wait for opportunity. Pfizer and CVS are attracting activists. Yes to Pfizer, maybe to CVS. I don't like it. I like it anyway, so we'll leave it there. China markets warn Xi that more stimulus is needed. No kidding. UPS, FedEx stocks are ripe for buying. The case for a shipping upturn. I've got my eye on those. They're kind of interesting. And now the article of the week, which I wrote 10 minutes ago, fake out or breakout stock market and sentiment results. So here's the chart of Alibaba. We're going to get back to it in a second. Here are my notes for Varney. We didn't get to cover the picks, which I was going to do VF Corp and Cooper Standard, but we ran out of time because the speaker before me was talking about how Kamala Harris likes to exercise on an elliptical and watch F1 racing. So there you go. That does take precedence over Tom Hayes' view of Bracken Darrell. I completely agree with that. General market, I'm joking and very grateful for any time I get on, to be honest with you. So, okay, we have said to expect 3 key developments. Number one, we had told you to expect a counter trend rally in the US dollar despite the intermediate long-term trend of being down. 2, counter trend rally in the U.S. Treasury 10-year yield despite the intermediate term trend being down, and we've got that, which we covered. 3, a punishing consolidation for everyone who bought Chinese stocks in Alibaba after it rallied 50% off the lows in a matter of weeks. This is healthy and will take out the late money weak sisters before the next move higher. I anticipate this pullback will last a couple of weeks to a couple of months. Once all the new money that chased up gets flushed in the hole, we will power back above 120 and beyond again. If you look at the featured image of Alibaba on the top of this article, you will find the current pattern is pretty normal after coming out of despondency. The question is whether the current blue circle, circle 1, several months of violent consolidation before a huge move higher, or circle 2, several days or weeks of moderate consolidation before a huge move higher. So let me show you what I'm talking about. Circle 1, it's here. Are we here or are we here? Are we here or are we here? So you got this initial thing. I'm kind of the view that we are here, and the reason is because we did have a violent move off the bottom and then a large consolidation, bigger than normal. So I think the odds favor this. I'm not opposed to this or this. That just gives us more opportunity to get some more exposure. But now that we got a lot of cash, but I think we're more like here, and we're probably going to keep pounding higher over time, and that's going to be great. And this would also be more consistent with a view that once we get through, once this thing starts going, they're not going to let anyone in. And as you can see in the last 4 weeks, they didn't let anyone in. No one was buying until it was already 115, 117. They missed the whole move, and that's why they're going to get they're getting punched in the throat now. Get rid of those late shares, give them back to strong hands, and then we'll go higher. Next is, so we favor the latter, but are open-minded as the intrinsic value is still dramatically higher than the current price. We would love a chance to reload long-dated options. Would have to temporarily drop below $100 a share for me to execute on that for another 5x plus bagger, depending on the vintage. But we are content just owning all the stock for the long term. We have not sold one share, and we own a ton. And aggregate much lower, much lower levels. So where is Alibaba on the Justin Mammoth's emotional cycle that we've covered several times over the last 5 years? You tell me, and don't quote unquote deny it. So our case is that we're not here, we're more likely here, in which case after a little bit of consolidation, after that first violent move up, we are going to make another violent moving up, and just here is when we're going to start to see those headlines turn to China is going to be the largest country in the world, blah, 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 overtake the U.S. They're not, by the way. They're going to take a run at it the next 3 to 5 years, and then they're going to be toast because the one child left behind, and we're going to ride this parabolic move and sell to those excited people who are the most negative at the bottom. Cooper Standard, I love, well, I don't love this, but I'm going to go through some information here. I love the company. I love the stock. I don't love why they might have a short-term catalyst. One podcast, VideoCast, recent podcast, I mentioned that I estimated $3 a share in earnings per share for every 200,000 cars of U.S. production above 15.7 million annual SAR. You should click here if you don't know Cooper Standard. We started our position in the low $5 range in May 2022 in size, and we've added over time. It's cheap as hell even here in our view. And so go read the thesis and see the progression over the years. Hurricane Milton is a tragedy. It will leave devastation in its path, destroying homes, schools, hospitals, and more. By the way, hat tip to my buddy Jackson. You know who you are. It will also destroy a lot of cars that will be total losses and replaced with new ones by insurance companies and owners. One of the points we have emphasized repeatedly is that in 2017, when Cooper Standard earned $7.19 a share and traded at $146 per share, the U.S. had 17.1 million SAR, which versus now 15 and change. What I did not realize is that was the same year that Hurricane Irma and Hurricane Harvey hit the U.S. hard and took 630,000 cars with it that needed to be replaced and helped with the peak SAR number. So that probably contributed, maybe the peak run rate then was 16.5 and they got 637 cars. That took it to 17.1. Maybe we're at 15.7. You get 600,000 cars. You're at 16.5. You're adding 800,000 cars, which at $3 per 200,000 above 15.7. You're looking at they'll screw it up. So you're looking at $12 a share. So even if they screw it up and wind up with $8 a share, you tell me the multiple. Is it going to be a trough multiple of 10 times or a peak multiple that they had of 20 times? If Milton is anything like these two devastating hurricanes in 2017, there will be another 500,000 cars required than estimated over the next 6 months. Using the rough operating leverage formula I've calculated and the impact on EPS for CPS, it's possible we could hit our earnings target much sooner than anticipated, and the implications would be massive. Time will tell. If Milton is not as extreme as anticipated, the previous timeline is still in play. If Milton wreaks unexpected havoc, our timeline could be quickly accelerated. On to the general view. Greed is at 72, so getting closer to extreme on the fear and greed, although the National Association of Active Investment Managers still at 86.64, which is not quite extreme. So we're kind of in this grind sideways mode. Okay, so congratulations to all the new clients that came in during our early Q2 and Q3. We reopened to smaller accounts starting last Wednesday and will remain open to the end of next week. To see if you qualify and take advantage of this opening, click here. Larger accounts, 5 to 10 million, can access bespoke service at their preference here. Enter your information, not a solicitation. As always, the podcast is opinion, not advice. See terms at hedgefundtips.com, and also disclaimer at the end of this video. Consult your financial advisor, and have a nice day. Move on. Earnings, healthcare, top 30 weights, revisions in the last 60 days, revised up for 2025 by 0.58%. So that's good. Same with financials, revised up 21 basis points in the last 60 days, top 30 weights for 2025. Earnings revised down, like I said, from 277 to 276. Still going to have 14% growth. We'll see if they take them back up. They've set the bar low for Q3, and GDP now is actually climbing from 2.5 to 3.1 in the last week. So we should see that be helpful. All right. As far as economic data, the big one is CPI tomorrow. Nothing else really glaring here other than that. And PPI on Friday. So the podcast is done. We're going to move on to the Ask Me Anything questions. We've got quite a few this week. So let's kick it off now with Will Kuharski. You said in the past, if NVIDIA keeps up with this mega growth, would become 1/3 of US GDP. If this is true, at what point is the shiny object no longer popular taxi driver story and can no longer sustain its market cap? Is it even possible to be a double from here, 3.2 trillion to 6.4 trillion? If not, what's the reason to hold it besides the popular name when you can get returns on many stocks you mentioned down 50 to 60%? For me, I see no reason to own it, so I'll leave it at that. But, when you have the CEO telling you that demand is quote unquote insane and he's dumping $1 billion of stock at the same time, I watch what people do, not what they say. So we'll leave it at that. On to the next. Drew Byrne, what are your thoughts on Endava at the current valuation? It's not a made-up position of mine. Added some recently. We've covered this before. It's like a UK software company. It's cheap, but you really have to know the industry. I think you could take it for a trade and be okay. On to the next one. I like the business, but again, what's the moat? What is the moat? How you have to have absolute to make it a big position. You have to have absolute confidence that they have a software moat in a growing area that no one can breach it, and it's not trading like it has that. So This is not about generators that have 70% of the market. You can sleep at night. This is like someone could come in and put them out of business overnight, which is why Buffett never did technology. So let's move on to that. But on balance, you're probably okay. All right. Moving on to the next one. Tim, thoughts on ticker CNXC. Cash flows declining, revenues are okay, margins are, can't see. Technology-infused customer experience solutions. That sounds like a whole lot of bullshit. I got to be honest with you. Technology-infused customer experience. I mean, it sells like aromatherapy. I mean, like, what do you? Company CX process optimization, technology innovation, front and back office automation, analytics. It sounds like a Me Too company. Let's see if they're generating some cash. There's no way you're going to ever have full confidence that they have any type of moat and they can't be put out of business tomorrow. But as a trade is a different story. So low return on capital. Let's see, cash flow. It's probably okay for now. Yeah, cash flow is okay for now. What's the balance sheet look like? Probably okay. 264. $5 billion of debt on a tech company and on a tech-infused customer experience company. My goodness. I'm going to say pass. Moving along. Elf. No one wanted it at 15. Now everyone wants it at what, 150? Let's see. Yeah. So you're stuck in recency bias. You're like, wow, it was 221. Now it's only $100. I mean, it was $6 3 years ago. I think this is Me Too. For me, I'm going to pass. This looks like a broken momentum stock, and I'm just going to leave it at that. Maybe it works for a trade, but I think it's way too early to get involved in that. Favorite books that you've read? I talk about it all the time. Dominic Harlan. Number one, you need to go to BerkshireHathaway.com, read every single annual letter that Buffett's ever written. Number two, The Intelligent Investor by Ben Graham. Number three, Security Analysis, also by Ben Graham. Those are the key. And then read a lot of annual reports. I like source material. I don't like secondhand material. Okay, let's see here. Vinod asked about Apache. I'm not interested. We've looked at that in recent weeks. Probably good for a bounce. I just don't like it. I like Comstock Resources, and I own Comstock Resources. Patrick McKenzie, MicroStrategy, not for me. Pass. Wrong podcast. Richard McCrae, huge fan since mid-2022. Thank you. A long-time listener, first-time caller. Thanks for sharing your knowledge and experience. I followed your TLT trade some months back with positive results. Yeah, so we told you when we took that off. Price of TLT. Are you considering buying TLT calls again around the current price? No, because it was way more asymmetric. I think you could grind for a while here, and that's how you get hurt buying premiums. So, yeah, I see I know what you're talking about here. It's just not as asymmetric as it was. I mean, when we were buying it, it's like it's a completely different story. This is going to work higher and higher over the next few years. I mean, we had a win on that. So I don't know when I'm going to get back in or if I'll ever get back in. I think there's other derivative ways I want to play it. I think utilities are going to get hurt a little bit more, which tells me yields will probably go up a little bit more. So I'm going to just table that for now, Richard. But your thinking process is correct. I just don't, it's not a fat enough pitch like it was when we got involved. Vincent Sentmore. Hey, Tom, happy to see everything's been going great for you. I'm curious on your thoughts around Wendy's. Strong fundamentals, standout, trading below 5-year average PE, and a dividend. I don't know. This is a me too. We got another. I do want to get involved in restaurants and consumer discretionary. This is not the one. I don't know. I looked at this a while back. I don't really love it. I'll tell you, I'd rather play around with something that's just tanked, like Jack in the Box, which another user asked about. I'm not ready for Wendy's. I mean, if Nelson Peltz couldn't really turn it around, I don't think there's a lot there. And I think I went to one and I wasn't really happy with it. I don't know. Or every time I think about going to one, I'm like, I don't really want to go there. And then I just keep driving. So whatever. It's just not for me. Jim Jones, if a equity jumps extremely in a short amount of time, but not your price target, what's your process? Well, my process is we will take profits on the options because they'll be up, if it's straight premium, they'll be up 3-4x. If it's spreads, it'll be up 4 to 7x. So we do take profits, but we generally don't sell any underlying stock until it hits our full price target. Michael Ozurick, regular listener, your fantastic analysis. Could you please share your thoughts on SQM? Yeah, this is chilly. I do want to get some exposure in Latin America. The fertilizers, potassium nitrate, chemicals, blah, blah, blah. Largest exports are to China. Well, that's why I don't play that, because I have enough exposure to China with, and that's what you have to be careful of when you look at your portfolio. I'm looking for relatively uncorrelated bets. I think this is going to work just like Bob is going to work, because it's going to be a China play, just like Goose is going to work, just like VF Corp is going to work. So the last thing I need is one more. But would I consider this one for a fresh one? Absolutely. I think I absolutely. Let me look at the financials here. Negative free cash flow declining. This, they're kind of in hard shape here. Margins declining, cash flow declining, revenues declining. Price is probably priced in a lot of it, but not in love. Let's take a look at the balance sheet. I'm going to tell you right now, I think there are easier ways to make money. $2 billion in debt. The balance sheet seems okay. I think you'll probably do okay with this. It's probably going to take longer to build a base than you think. It's not going to go straight up. I think it's a pretty good find. I think it's time to start to look in Latin America and South America. So I like the thinking here. I'm not ready for it, but I think you'll do fine. Mentioned closing out 3M in the mid 120s from the low of 73. Yeah, but you also got Solventum number one, and we also made a ton on our options. So, and we wanted to book a win because the thing about the advantage that an individual has over a PM is that, as a PM, you have to book wins because you have to deliver returns. So you can't just ride everything up and down all the time. So when something gets close enough to your targeted value and you feel like the market's a little bit overdone at the time, you book the profit, and you don't be a pig and you leave the last few percent to someone else. But on that one, if you look at what our options did on top of it and the total return with the spin shares and everything else, we're perfectly comfortable with that. If it backed down to like 100 again, would we relook at it and see what the business looks like now? You bet we would. We just thought that, with the vast majority of their litigation risk in the rearview mirror, we got paid for that. but there's still some tail of risk on that, and then they've got to turn the business around, which they seem to be doing. It will be fine, but we would need to get it at lower prices to get interested in again. This is Jan asking me about Walgreens Boots again. Every week someone asks me, and every week I say no. Have at it. It's going to be it'll work as a trade, but I don't want to own that business long term until I can walk into a Walgreens and not have to page some schmuck vaping in the corner to take 10 minutes to come over and get me Gillette razor blades. I'm not interested. On to the next. Next time I'll tell you how I really feel. Lachlan Neo, what are your thoughts on Alliant? ALNT. What is this thing? I think it's sells precision and specially controlled motion components and systems for various industries. Brushless DC motors, torque motors, gearing drives, motion rollers. Alliant. This is a tiny company. I mean, that's not really the kind of stuff we do, unless it's called Cooper Standard. Let's just see here. Not a great business. It doesn't generally generate a return on investor capital, but it is generating free cash. How's the balance sheet? $230 million of debt relative to $30 million of cash. Not a good enough business for me to get interested, but I think it might work for you. Good work, Samar. Do you agree that leases should be classified as debt or not? Generally, no, but I'm not losing sleep over the fact they made the change, and you got to play the hand you're dealt, not the hand you want. David Oliveira. He's asking about the repurchase program that they have and the cash that they have. Number one, your numbers are not correct, so read that carefully. But they're not going to be buying back stock yet. They sold off the other business to deleverage. Now they're going to get it efficient. These 2 quarters are weak, which they said would be weak, and they'll get the hub and spoke model in place for this distribution center, and then they're going to start to expand 100 stores a year. It's going to be great. And if you ask anyone who knows anything about Shane O'Kelly and what he did at HD Supply, it's just to sit on your hands and wait, and he's going to work his magic, just like Bracken Darrell, just like Alex Chris over at PayPal. These are all winners. We bet on these jockeys, and this one will be no different. Is your market cap target for BABA $1 trillion, $800 US price? No, never said that, never even alluded to that. So this must have come in. Yeah, this came in last week when the stock was at 120. Landon H. Been tracking Jack as a potential to buy due to significant opportunities for cost cut. Growth opportunities for both Jack and Del Taco. What are your thoughts on this idea? I generally like it, and I'm generally interested. And I've not done anything yet because I wait for fat pitches. But this is getting closer and closer to a fat pitch for me. But we're not there yet. Thing I find when I go to California all the time is that, like, I walk into there and they just have so many options. That's kind of like, I don't love that, and I don't like this negative free cash flow either. This is kind of not ideal. Seems like a confused menu. Revenues are starting to pick up. Margins are going down. I think they're just trying to throw a lot of stuff at the wall. They'll have to clean up that menu and normalize it. But the fact of the matter is, everything there is pretty good. I mean, if you're not looking to take a blood test the next day for your physical, it's not the end of the world. So I think eventually they'll get it right. I think it might be a little early. That's a new client. And TXT, I'd rather buy Boeing. Boeing can drag on and go down another $20, but at the end of the day, it's going to be 250, 260 in a year and a half, and probably over 300 shortly thereafter. So I'm not really worried about it. TXT has run a lot. I'm sure it's got good numbers here. Cash flow has been going down. Stock price has been going up. Revenues have been recovering. Margins are kind of bumpy. I don't like it as much. I think this thing's up 5x in the last few years. Why are you interested now? Wrong podcast, but probably a good company, and I don't think you get tremendously hurt doing it. I just think there are higher and better uses for your money right now. With that said, we'll be back next time. By the way, anyone going to be in Scottsdale or Phoenix, newer potential clients in the next 3 days from Friday through Sunday, want to grab a quick coffee. Probably won't be able to do a meal because I'm there to hang with my kids and my wife. Love to do that. Just reach out through hedgefundtips.com. We'll be back next week, probably from Connecticut. And in the meantime, make it a great one. Bye for now.